In finance, individuals and institutions constantly seek avenues to grow their wealth. Two popular investment vehicles stand out: mutual funds and exchange-traded funds, or ETFs. Understanding the nuances of each option is crucial for making informed investment decisions. This guide aims to provide clarity on these investment products, empowering you to make choices aligned with your financial goals. Both mutual funds and ETFs offer investors a way to diversify their portfolios. They provide access to a basket of assets, such as stocks or bonds, through a single investment. This diversification helps to mitigate risk and potentially enhance returns. As with any investment, it is essential to carefully consider the characteristics, advantages, and disadvantages of each option. Mutual funds pool money from multiple investors to invest in a diversified portfolio of securities. These funds are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds typically aim to achieve specific investment objectives, such as long-term growth or income generation. They offer investors a convenient way to access a professionally managed portfolio without having to select and manage individual securities themselves. Mutual funds are priced based on their net asset value, or NAV, which is calculated at the end of each trading day. The NAV represents the total value of the fund's assets minus its liabilities, divided by the number of outstanding shares. Investors purchase shares of the mutual fund at the NAV. Mutual funds also charge fees for managing the fund's assets and covering administrative expenses. These fees, known as expense ratios, are expressed as a percentage of the fund's assets. Investing in mutual funds offers several advantages, particularly for individual investors. One significant benefit is professional management. Experienced fund managers leverage their expertise to make informed investment decisions, aiming to maximize returns for investors. Another advantage is diversification. Mutual funds invest in a variety of securities, reducing the impact of any single investment on the overall portfolio. However, mutual funds also have drawbacks. One notable disadvantage is their higher fees compared to some other investment options. Expense ratios can eat into investment returns over time. Additionally, mutual funds lack the flexibility of trading throughout the trading day, like individual stocks. Investors can only buy or sell mutual fund shares at the NAV calculated at the end of the trading day. Exchange-traded funds, or ETFs, an overview. ETFs share similarities with mutual funds in terms of providing diversified exposure to a basket of assets. However, they differ significantly in their structure and trading mechanics. ETFs are listed on stock exchanges, and their prices fluctuate throughout the trading day, just like individual stocks. This intraday trading flexibility is a key distinction between ETFs and mutual funds. ETFs are designed to track the performance of a specific index, sector, or asset class. For instance, an ETF may aim to replicate the returns of the S&P 500 index or a portfolio of bonds. This passive investment approach typically results in lower fees compared to actively managed mutual funds. Moreover, ETFs often offer greater transparency, as their holdings are disclosed daily, allowing investors to see exactly what they own. ETFs, advantages and disadvantages. The liquidity and lower costs associated with ETFs make them an attractive investment option for many. Their ability to be traded throughout the trading day provides investors with greater flexibility to react to market movements. Furthermore, the typically lower expense ratios of ETFs can contribute to higher net returns over time. However, ETFs are not without their drawbacks. While their passive investment approach aims to track a specific index or asset, it is essential to note that ETFs are still subject to market fluctuations. The value of ETF shares can go up or down based on market conditions, and investors may experience losses. Additionally, while ETFs generally have lower expense ratios, investors should be mindful of trading costs, such as brokerage commissions, which can impact overall returns. Thanks for watching. See you in the next video.